Good afternoon, ladies and gentlemen. Welcome to our second quarterly update for the year. It's been an eventful 6 months, so to speak, and that's putting things very mildly. We've got a lot to unpack here on our docket for today's session, but before we dive in, just a few housekeeping rules and some disclaimers for compliance purposes. Information presented here is for educational purposes only and does not intend to make a solicitation or offer for any specific securities or strategies discussed herein. Please be sure to first consult with a qualified tax professional and/or advisor before implementing any of these strategies discussed. With that said, we will be jumping into the webcast. We will have a dedicated Q&A session as well towards the end, so please do save your burning questions for then, or alternatively, just feel free to post them in the chat and the Q&A function, and we will pick up on them as and when are appropriate for this webcast here. So what do we have here on the agenda today? As the cover slide there showed, we've got some choppy waters ahead of us. There's a lot of things going on, or that have gone on in the last couple of months, that we've been paying close attention to. And really unpacking this is going to be an exercise in of itself, because I think between the politics and everything else, there's just a lot going on that needs to be unpacked. But we'll be diving into the main aspects there in currencies, inflation, and touching upon the elephant in the room there, which is really what's going on with the tax front. And that's a great segue into the big, beautiful tax bill. And by the way, that is the official name there. So Alex, if I could have you come up here on this cast, why don't we sort of unpack for our audience what this tax bill is and how it impacts some of our clients?
Okay, well, there are a lot of provisions that have made it into the final bill that didn't make it into the final bill. It started as a House resolution, went to the Senate, then went back to the House, and it was signed into law on July 4th. So the most important takeaway, and there are a lot of things in the bill, obviously, but the most important takeaway is that there is a section 70604, which impacts expats, could impact expats, I should say, which is the excise tax on remittances. So what this means is that any transfers of cash from the US to a foreign destination that occurs after December 31st of this year will have a 1% tax added to it. So the earlier proposals for this said that US citizens were going to be exempted. There was also a proposal that a tax credit be given to US citizens who had to pay this excise tax, but those proposals were scrapped in the final version of the bill. So it's a little bit vague the way the bill is written. The firm has talked to multiple tax professionals, and everybody seems to agree that the interpretation of the bill is going to be a little bit in flux. So you have some choices about what you can do in response to this. Obviously, if you have large cash balances in the US, you can either move them offshore before December 31st, 2025, or there are some other planning techniques that can be used after that date. The important thing is not to think that there needs to be a rush to move everything offshore. Because this bill is open to interpretation, you might take the more conservative approach and try to mitigate the risk that the bill could pose and move funds offshore.
In other words, if there's small dollar amounts, Alex, probably nothing to worry about because of a 1% tax. If you're buying a house in January, maybe send the funds over from your US account in December. If you've got long-term retirement needs, maybe move the bond portion of the portfolio to euros prior to December 31st. Right? So more just alleviating strategies instead of anything that we should panic about, because the institutions, we don't know which institutions are going to be qualified institutions. It's not clear. And this administration might use that to weaponize it so that they have the control, even though the executive branch shouldn't have control of taxation.
Precisely.
Some good news, though, from the bill, Alex. We've got some pieces like the child tax credit. A lot of our clients get the child tax credit. That's been expanded, an extra $600. So any of you that are against filing U.S. taxes but have a child, you might actually be getting money back from the U.S. government instead of paying money into the U.S. government for filing taxes. So that's a nice one. The standard deductions. Any of those individuals that have a very simplistic tax return, those thresholds have nearly doubled for both single and married individuals. So lots of good news from that vantage point. Some other deductions gone down, mortgages and the SALT deductions. The SALT is the state and local tax. Might be because some of the biggest states that actually have state taxes happen to be a little bit blue. I wouldn't say that they're trying to weaponize tax code in any way, shape, or form, but well, probably just ironic, right? Some of the provisions sunset, Alex.
Which provisions are you referring to? There's so many.
I think it might be the corporate deductions for research and development and such. The main thing is this is acting as a stimulus for the economy right now in the short term because it is a significant, is it $3 trillion of tax cuts?
I thought it was 4.
Three to four, a significant amount, we'll call it. A lot of potential stimulus on there. But at the same time, it brings about some unknowns in the short term for expats. So we're going to be continuously talking about that with strategies before January. And it plays into our theme of wanting to decrease our US dollar exposure from different terms. So we'll want to have that conversation with each and every one of our clients.
I think that's a great segue onto the next item here, which is planning. We'll focus a little bit on some of our UK planning opportunities here, in regards to some of the different, I guess, vehicles that we could be utilizing for American clients here in the UK, especially in relation to some of the changes both here in the UK and in regards to that latest US tax bill that we were just discussing. Anne, why don't you unpack that for us a little bit here of what can some of our clients here in the UK be looking at to potentially optimize their tax situation?
Yes, the UK team at Dunhill Financial has been talking to their clients, their UK clients, about SIPs and ISAs. ISAs are individual savings accounts. You can put, 20,000 away. There's stock and shares ISAs or cash ISAs, which is kind of a UK tax change that might happen down the road. Rachel Reeves has been talking about changing that, but we think that you should think about doing your ISA now instead of waiting. There is a caveat for US taxpayers, so just be careful and talk to your advisor to make sure that you're in the right place and it's the right strategy for you. SIPs, on the other hand, are self-invested pension plans. You can put a lot more money away in it. You can put up to 60,000 pounds away each year, and you can front load it for 3 years. So it's a bigger planning opportunity if you have the cash flow. And even if you have no UK earnings, you can put some money into a SIP. So just be careful, talk it over with your advisor to make sure it's appropriate for you, because they can help you make a strategy to specifically direct your specific investment and tax situation.
Great. Well, I guess now we'll dive into the actual economics part of this update. But again, thank you, Anne and Alex, for unpacking some of the tax bill and also some of the planning opportunities there for some of our clients. So takeaway there is please do reach out to your advisor. to discuss, some of those opportunities and how, those tax changes could potentially impact you. Again, we want to be having those conversations with our clients to see where we can strategize. Perfect. That brings us on to the actual update of what the hell is actually going on here. And we're going to stick with the water analogy here, and we're water and sailing analogy, I should say. And as I mentioned earlier, the last 6 months have seen a lot of things happen. Whether it's on the geopolitical side or the economic side, and various different aspects there that are just really driving different parts of the market. And I think the takeaway there is that things are going to remain a little choppy for a while. So with that, I'm going to segue into currencies, which is one of our big talking points here. So Brian, why don't we unpack first of all, what is it that actually drives currencies longer term?
Well, in the longer term, typically it's fiscal policy, monetary policy, growth rates, and interest rates. In the nearer term, it's really been determined based on the safe haven currency being at the center, i.e., do people trust in the US dollar at this point in time? We've seen probably 3 times in the last decade that people have gone the opposite way. As they get scared during COVID, during the financial crisis, they wanted to move their money into dollars as a safe haven. The exodus is happening right now as Trump tries to take away that safe haven status of the US dollar. And as we've talked about many a times, historically, when a president tries to devalue the dollar, it can last for long periods of times, 10, 15 years at a time.
Mm-hmm. Okay, so why don't we unpack this slide here that we're looking at for our clients, Brian, for a second. So we've got the GDP growth rates for 24 and 25 for 5 of the largest economies out there. Now, typically, as you mentioned, growth rates are one of the aspects that drive currencies. From this chart, at least, it looks like, the growth rates in the US are, pretty decent, at least from a historical standard, and especially compared to Europe and the UK. So I guess the question I had for you is, despite some of these projections indicating better growth rates in the US, why has that not translated into the currency side of things? I.e., why have we continued to see a weaker dollar?
Well, in simple form, it's no longer the most important aspect. And there's a lot of views that this will slow down growth in the United States. Even Powell is stating interest rates being higher to ward off inflation will slow down the economy. And that's what we see in this chart. The US 2024 consensus GDP numbers a lot higher than next year. Whereas we're getting growth rates in the Eurozone and the UK, mostly on military spending. So it's a psychological effect. It's the sociological view that, hey, is America the safe haven? Is that the place and only place to invest, especially if dollars are coming down?
It's an interesting way to, especially in the last couple of months of how, currencies typically behave, right? I mean, on this slide, if we look at the dollar, so just to unpack it for our audience here, the dollar is the purple line, or depending on your screen, it might be a different color. And then we've got the euro and the pound in orange and blue, respectively. So again, just looking at the last 6 months there, those have been pretty substantial moves, just in a very short span of time there. Why would a question I guess I have here, Brian, is why do you think we're seeing such a profound weakness in the dollar, and why is it that the pound and euro is rallying to that extent? Is it because there's better growth opportunities in Europe, as you were mentioning, because there's more those spending bills, or is there something more structural at play? Again, tying back with one of the some of the goals that the administration originally set out.
Well, as Alex was talking about with the big beautiful tax bill, there's fears of what happens if you own U.S. dollars. What will they do with U.S. dollars? the ratings agencies have reduced, all of them have reduced the status of US bonds, i.e., there is this trend universally, and it's being led by the executive branch, that you shouldn't know whether you can trust the US government at this point in time. And when you can't trust them, that de-dollarization is going to be accentuated throughout society. And China is playing the exact opposite side. They have basically reached out, arms wide open, to all 54 countries in Africa to try to establish more connections with the renminbi at this point in time. The only reason that the dollar hasn't declined further is because the question is, where should it go? If interest rates go down further in the US, if they go down to levels that the EU is at instead of the levels that the sterling, the pound is at, which is currently around those same levels, we will see another 10 to 15% come off the US dollar, which is why this next step is no longer just about the executive branch, but all about the Federal Reserve. And we know exactly where Trump is trying to push Powell, or trying to push for a new Federal Reserve chief that he could push around a little bit more. He would like the Fed rate to be at 1%, which could be lower than the euro. If your interest rates are lower in US dollars than euros, somebody that's trying to collect coupons is probably going to move their money to euros instead of US dollars. So this is why it's only the first step in that trend, on that de-dollarization trend.
So speaking of de-dollarization, and again, not to get too carried away there, but Brian, you and I have had several conversations in the past about how typically we see these long, protracted cycles when it comes to the US dollar, right? Where we have periods of strength and we have periods of weakness. Why don't we unpack for our audience here a little bit of what we're looking at? We'll skip past this slide actually, and we'll go into the next one because I think this one really drives home the point here of why we've seen such exceptional strength in the US dollar over 15 years now at this point. And as you said, if now is really that turning point, where do we want to be positioned potentially?
It's a great question. I mean, in the last 20 years, most of the dollar's improvement has been based on the view of the investment potential in the US dollar and higher interest rates. Interest rates have been higher in US dollars than they have in, say, euros or pounds. But during that 20-year trend, we basically had the technology boom on the US front. There was an article not too long ago in The Economist that basically was stating that the stock market in the United States and the stock market in Europe had about the same size market cap in 2000. I haven't measured it recently. Cam might have this off the tip of his tongue, but the US stock market is phenomenally bigger than the European stock market nowadays. And that's all come from the last 20 years. And that's pushed the dollar up significantly in that given time. More recently, there's been functions in this last year. Sanctions against Russia means that all Russian oil no longer actually clears through US dollars. It clears through renminbi because they're selling to the Chinese. We're seeing more and more commodities de-dollarize. And these are all those functions that post-World War II were what made the dollar such a important currency, was the fact that most all commodities traded in that currency and most all debt traded in that currency, therefore giving them the opportunity to have significant amounts of debt.
Mm-hmm. I think that really ties on to the next slide here, actually, which, as you pointed out, the sheer quantity of US ownership, both on the debt side and the equity side of foreigners, has only grown in those 20 years, as you mentioned, minus this treasury holding, which I think that could probably be described as, probably prudent de-risking from the various different nations there due to, policy or trade wars, etc. But if we look at this chart on the right here, Brian, which is the US equity ownership of by foreigners, it's only gone in one direction over the last 20 plus years. So my question to you here is, if we see this trend continuing of a weaker dollar, is there a risk that potentially more foreigners and sovereign funds and nations at large start pulling some of that US equity exposure back home to their domestic markets, i.e., could we potentially be seeing a at least pause to the US exceptionalism trade?
I don't think so. There's part that you could theorize that it could happen, but I don't think so, because the biggest growth engines of the global market are in the tech sector, predominantly right now, AI, but it goes beyond AI, and we can go into all different kinds of fields like EVs, grid technologies, cybersecurity, all different forms of technology. And the predominant place to invest in those are in the United States or in China. Right now, Chinese securities, because of the attack trade-wise from the US, are selling at such a huge discount since the first term of the Trump administration. So if you go ex-US and you don't invest in the US, you're missing one big sector of the overall stock market. It also makes up 57% of the world's market cap. And while we talk about these types of elements, we're in a week where two of our biggest stocks here in the UK are still looking at getting listed on the US stock market. AstraZeneca and Wise. It's all over the news in the UK. There's still this exodus of companies coming out of developed markets into the US. On top of that, you've heard we've talked about it many a times that it doesn't matter so much where a company is headquartered, it matters more where their revenue comes from. That gets us the currency basis. And right now in the S&P 500, which is made up of 520 stocks, essentially it averages around 40%. If you go into the tech specific Batman stocks, it's 60%. Companies like Google are up to 66%. So are they really US companies when 66% of their earnings come from abroad? They're global companies. So it just happens that we're buying them from the US. That being said, a little bit of a hiccup can go a long way. The average stock on the US stock market is right now trading at a forward PE ratio of 27. The average stock on the FTSE is trading around 17. Right? That's a vast difference. So if we have a reversion to the mean, if we have a reversion to pricing on global levels, we can see a drastic pullback if people are no longer giving that premium to the US. But I tend to think that the premium to the US isn't US exceptionalism. It's that the US markets are in the right sectors. And that's what you're buying for, are those future price to earnings. That's why we quote them in those types of ways. But the key is going to be diversification. America makes up 57% of the world's market cap. It basically means if you have a primary US portfolio, we see a lot of the investment banks in the US allocating 80 to 90% into US companies. If we're wrong about this, they could have a long and hard drop. If we're instead benchmarking ourselves against that 57% and maybe owning a little bit more, 60 to 70%, at least we're going more with global indexes instead of primarily being in the most expensive. That's why I think we've had this sell-off, is not because people are thinking the US is done when it comes to the equity markets. It's because at this point in time, if we have a pullback created by that fifth risk, which is basically management ineptitude, is how it's defined by Michael Lewis. Essentially, we have a big deal to fall, so you buy cheap. You sell part of your US and you buy international because you're buying at a lower valuation. 15 years, we've been on a growth trend, right? We're overdue for that value trend that used to historically come in our financial planning books as a switch over every 6 years. So well overdue, and that's why I believe that Europe has had a really good beginning to the year.
That's a really good point there that you raised, Brian. And I would say, just to summarize there, I guess the takeaway is on the equity side, we don't really mind, having some of the US exposure, because as you mentioned, a lot of those companies derives a vast amount of their revenue exposure from outside the US. So, in non-US dollar currencies. So all of a sudden, when you translate those earnings, then possibly in the next coming quarters, we could see, you know, good earnings growth just off the back of currency weakness for some of these companies in the coming earnings season.
Absolutely. And the number one rule in financial planning is always diversification. So having pieces across the board is going to help us in significant ways because we're not going to get it right across the board. We keep joking about the taco trade. Trump always chickens out. And it's fun to laugh at, etc., because we've seen it with the tariffs. 90-day extension. Now we're getting a 30-day extension. But at the same time, we're going to have winners and losers. Poland and Spain have been our biggest winners, mostly because their stock markets are isolated. They mostly trade in Europe instead of with the United States. If all of a sudden Europe gets a great trade deal with the United States, Poland and Spain might actually revert back to their means. In other words, these are places that are great for traders, not necessarily for our long-term retirement accounts.
Mhm. Gotcha. Okay, we're going to move along here just for the sake of time. I'm conscious that we want to make sure we have ample time for Q&A for. So we touched on the equity side here, Brian. We're going to skip really quickly over to the bond side. So equities, I think we've covered ad verbatim of having an international exposure isn't or having a slightly larger US exposure isn't the end of the world. But what about when it comes to our fixed income exposure, i.e. the safe part of our clients' portfolios? What are your views there of where clients should be looking at to get some of that bond exposure, and potentially what are the currency risks that we should be mindful of?
See, I'm gonna break this down. We have two CFPs on our panel right now, and so essentially, in financial planning, we want to make sure our safe money is identified for the right goals, and that basically means anything that we need in the short to midterm, 1 to 3 years, should definitely be identified in the best ways to meet those goals. If we're going to buy a house next year, and we're going to buy that house here in the UK or in Europe, those funds should probably be in euros or pounds, even though the interest rate is a little bit lower in Europe and about the same in the UK. But essentially, that means we're not taking the risk of a big move, like you showed earlier, a 10% downward move in the US dollar. So the first rule of this is the financial plan should determine a big part of what our allocation should be, and determining what those goals and needs would be in the near term becomes that much more important. On a grander scale, even though the average investment bank is believing that we're right around the rates that they're expecting for at the end of the year, the investment banks are wrong a lot of the time. And what we have to think about is just what you said astutely, Kim. This is our safe money. So essentially, we know that we're going to get lower interest rates in Europe, a little bit higher interest rates in the UK. But if we have our money in pounds, we're going to go ahead and get it tried and true moving in the direction we want to. We can have some pieces globally, but it's pretty much a US dollar trend versus the rest of the world. Anything we have in US dollars, we're going to have that ability for it to fluctuate significantly. And the Trump administration wants to push down the US dollar, which means in the short order, we might see a little bit of a bump up in the US dollar. Any of those bump ups, we'd use it to take advantage of increasing our foreign fixed income inside of all of our portfolios. And I'd even make that that judgment for a client that intends to go back to the U.S. If the president wants the dollar to go down, he probably is going to be able to get it to go down, just as Nixon and Reagan were able to do.
Mm-hmm. I think that's a really great point there that you mentioned on the longer term trajectory, right? Because if we move on to our next slide here, again, looking at it in isolation over the last 6 months, it seems quite steep and alarming. But if you look at it on a longer term trajectory there, Brian, as you pointed out, potentially right now, if we look at it from a longer term basis, we're kind of at fair value on the dollar. But again, a large part of that is being skewed by the sort of inflation shock of the 70s and 80s, which led to the plaza record and then that steep devaluation of the dollar. Would you say that potentially we're in a similar setup here, where basically the current administration is on pace to structurally weaken the dollar, regardless of what the means are to get there in order to achieve some of their objectives?
Absolutely. That is a lot of the nonsense that we see in the news on a daily basis. We have to remind ourselves that the big picture from this administration is if you devalue the dollar, then basically you're writing off, is it 8 trillion of the 31 trillion in debt on the
Yep.
cheap?
Yep.
I think it's 8 trillion by foreign governments. That doesn't include foreign investors in treasuries. So essentially, if you're able to write that down significantly, who cares about the manufacturing? Who cares about all of those other functions? You have just reduced your cost of that debt significantly. That is the economic principle behind what the government's plan is. And that's to where we could see this exact same movement over the course of time.
Mm-hmm. Gotcha. Just conscious here for time, so we're going to move on to our last point here, which is I think something that's really been grabbing the headlines. And again, we've unpacked some of the items there earlier on in this conversation, which again, the takeaway there is things are still going to remain uncertain. The waters are still going to be choppy. So how do we get to calmer waters and navigate some of that turbulence there on the waters? Which brings us on to tariffs. Brian, tariffs have really been the driving force in some of the headlines in the last couple of months. Really, this entire year after April's Liberation Day, or what I'm going to officially call it as a Obliteration Day, because there was anything but liberation from that day. So first of all, why don't we unpack what this chart is that we're looking at here for our audience, and really the significant impact of what it could potentially mean for inflation going forward, and what that means for the overall market.
Well, it's the disassociation of inflation from a U.S. perspective to a global perspective. Most of the time, basically all boats rise on a rising tide, and therefore, when we get inflation in one place, we're getting it across the board. At this point in time, it's questionable whether we're going to see inflation outside of any place other than America. So that we could see some dumping of products from certain places that can't get into America or can't afford to sell in America. We will see a lot of shifts of business, and that's what we really have to be mindful of in the next 3 to 6 months. Is if Powell is telling us he can't equate how this is going to impact the market, therefore he can't indicate with conviction what he's able to do in the next couple of months. The rest of us have to be mindful of how we deal with those aspects. And we deal with those the same way that we deal with most of our risks. We diversify around and we build barbell strategies of things that are going to help us. In other words, our big fear that comes from tariffs could be inflation. What do we have to barbell the strategy? The more bonds we have, the more commodities we have. One barbells the other. If we don't get the inflation, the commodities most likely go down. Essentially, the tariffs are also a great way for the U.S. government to try to continue to push down the U.S. dollar. So it's another effect that plays into that full tilt. We know that Donald Trump wants to negotiate everything. He wants to look like the hero negotiating through different deals. 90 deals, 90 days didn't happen. 90 days, 2 deals. Was it 2 deals or 3 deals? I can't remember.
I think two if you have a very wild imagination, but we'll go with two for now.
Yep. So Josh popped up. So that does that mean he has some commentary there?
No, just the only one that I was aware of was, well, the most prominent one was Vietnam anyway, but trade deals, if you're not familiar, generally take on the order of years to be worked out. There's a lot of negotiation rounds. I mean, the idea of it being done in 90 days is probably not a huge surprise to many people on this call that, we didn't quite get there. Well, maybe I'm surprised we got one or two, but
Well, it's either that or if Matthew Perry shows up on a boat to Japan, it takes days. But
I don't see what this has to do with Friends.
it doesn't. This was the original Matthew Perry.
All right. You guys need to look that up if you don't get that joke. Sorry.
The tariffs war is going to be something that we're going to have to watch unravel, and diversifying globally is going to be the key to manage that in many different ways, because there's going to be many winners and many losers, and Trump is going to be able to decide which ones are winners and which ones are losers.
Got it. And that brings us right up to time here. So we're gonna get the boat into harbor here. Apologies for the terrible sailing analogies, but maybe Brian, you can do one better for us. We'll really summarize with what's going on in the portfolios. I know we've discussed some of the changes that's happening on the wider macroeconomic stage there, but what are we at Dunhill Financial doing in some of our portfolios for our clients? As Brian was mentioning there, it's getting back down to that neutral weight on our US equity exposure. It doesn't mean we completely want to get out of that US equity exposure, because, a lot of those US quote unquote companies with an asterisk at the end get a large part of their revenues from outside the US. So, we want to have a healthy exposure there. Again, the other point that Brian was mentioning there is making sure that our safe money, i.e. the money that you'll be needing to spend for whatever aspects or goals that you might have in your financial plan, it's in the currency that we'll actually be spending it in, right? So having that in euros or pounds and mitigating as much of that currency risk as possible. And last but not least, touching upon some of the uncertainties that still remain on the horizon. We don't know how some of these tariff negotiations are going to play out. As Josh was mentioning there, it takes a good couple of years in normal times for them to be negotiated and hashed out. And the fact that we're trying to get these done in 90 days, there's going to be a lot of mishap along the way, and we're fearful that might lead to higher inflation, which is why we're continuing to maintain our commodity exposure there for our clients to have that barbell in place. With that said, though, that's the end of the webcast there, so we'll open it up to Q&A.
While we're waiting for the questions to come in, Cam, one of the big conversations we've been having is about emerging markets, you and I.
That is true. I think emerging markets have always been an interesting place, Brian, and you and I have had this conversation ad verbatim. But I think in the current backdrop, with the weaker dollar policy that we have, if that continues to remain, I think emerging markets could be an interesting place from a structural perspective. But then you start diving into the politics, and then it becomes a little bit more murky, right? So I think it's having a tactical exposure on the EM side, and particularly being very selective with where we get some of that exposure. But like you said, there is real opportunity there in the emerging market space, purely based on valuations, right? If we look at, for example, some of the tech names in the emerging market space, they trade at a fraction of their US counterparts. Now, some of that is rightfully because of, uncertainty and political risk, etc. But that has room to improve. That's my 2 cents on the topic. What about you, Brian?
Well, you know that I believe the emerging markets are different segments all into their own. So if we just break down the BRICS, Brazil is still politically a little bit of a tough shot. Russia is impossible to touch. India is a little bit expensive. Um, uh, China essentially would potentially be the whipsaw rebound if we wouldn't have a second coming of Trump. And South Africa is problematic in certain areas, but yet 7 of the top 10 stock markets, or I'm sorry, GDP growth countries were African nations last year. So we should be talking much beyond just the conventional BRICS. The demographics of emerging markets are what make them great. Any of them that actually can push the consumer are what's going to really help our companies. 2 of the top 10 companies in America, their biggest market is India. And that's because the average Indian is about 10 years younger than the average person in developed markets. Therefore, they have much more room to expand. Europe and the United States were being held back by the older generation because of government pensions and the debt that we take on from that. India doesn't have those. Africa is even younger than that, but it's finding the right ways to invest in these markets that aren't problematic. We can't get in on a index basis in India because then we own a bunch of conglomerates. And when we think about a company like Tata, well, Tata owns Twinings Tea. Is that how you pronounce it as a Brit?
Close enough, but I won't be the judge of that.
Land Rover, which is the most stolen car in England, and Jaguar. I.e., are you really buying an Indian company, or are you buying a company that is really enjoying buying a lot of English companies to run them? China owns Lotus. Lotus is closing down their factory here in the UK. A lot of it's the same thing with MG, owned by a Chinese company. What we don't want to own is a bunch of companies that tend to diversify themselves out of those jurisdictions. We want to get access to the younger demographic. So some of it might be by owning Microsoft, Meta. We already have access to some emerging markets. Other aspects of it are potential abilities to get to the consumer, Mercado Libre, or names like that, that can grow with the younger consumer in different marketplaces. And that's the part that's harder and harder to get access to because the markets aren't as large. So the more the dollar goes down, the more attractive emerging markets get, and the more this conversation it is a significant, important part of our investment committee meetings.
I have one question actually for you, Brian, while we give the audience a few more minutes here before we sort of conclude our webinar here. When we're looking at the US tariffs there earlier on that slide, what bears a striking resemblance is the current effective rates that are being proposed and may or may not go into place are very similar to what we had in sort of the 70s and 80s and even going further back to that. So my question to you is, how much should we be looking to the 70s and 80s as a framework, especially when it comes to the inflationary aspect? And could we potentially be seeing a repeat of that where inflation does come back to haunt us and then changes things very, very dramatically? What are your thoughts there on inflation and looking back to history for precedents?
I hope not, but we have to place ourselves in a position that we're ready to reflect on it if it does. If it does, it will be a tale of two cities. It will be 2 different marketplaces, and we will have places to continue to shift towards. But it just means a faster decline of U.S. exceptionalism. There's signs of a slowdown in the U.S. market, which hopefully will mitigate some of the potential of the higher inflation if the tariffs really increase inflation significantly, which I would assume that they should. But we have to watch those numbers come through.
Got it. So the takeaway is there, we'll continue to remain data dependent, like the central banks and many other economists out there, and act accordingly. Maybe that was the one good sailing analogy I got in in this entire webcast there. Perfect. Well, once again, I want to thank our audience here for tuning in to our session. Again, the recording will be made available on our YouTube channel for you to share with your family, friends, and anybody else who you think may find this useful. Again, we'll land the plane right here because we're close for time. And thank you all for tuning in, and thank you to our panelists here for giving their wonderful insights. And have a wonderful rest of the day.
Thanks so much, Kim. Thanks, everybody.